All right, so let's talk for a brief moment about when does it make sense to refinance your mortgage or restructure the loan terms that you have currently. Now, there's several hot buttons here, and there's a lot of myths that are out there with respect to this topic. The most common one that I hear is my rate needs to drop by a full percent. Well, that's not necessarily true because there's so many different reasons that people refinance. And I'm going to hit on that in another topic. At the end of the day, the mindset should always be if I'm not selling my house immediately, then what is my future? What are my goals currently, and what is my future equity going to look like? So there's really not a one size fit all option. Just throwing a rate out there is not something that I'm comfortable with advising. Unlike a purchase transaction, a refinance transaction is a financial decision because everyone handles their mortgage and their bills and their cash flow differently. Everyone has different needs at different moments. And you want to take into consideration not just lowering the rate by a 1%. Quite frankly, if you lowered the rate by 1% on a $70,000 loan, you're not going to benefit that much. The general rule of thumb would be if I've got a government loan with mortgage insurance, then I want to take a look at improving my loan. If I've got a conventional loan with mortgage insurance on a monthly basis, I want to consider looking at a new loan because the effective rate or the blended rate between the mortgage insurance and the payment is really what you're paying, and that is your cash flow. And primarily, most folks don't ask for I want the best payment. They ask for I want the best rate. Well, sometimes you might have a great rate. The rate might not change much or it might stay the same, but if you drop the mortgage insurance off, then you dropped about 1.5 off of your FHA loan, for example. On a conventional loan, the same thing applies. It might not be quite as dramatic. There's just so many different things to take into consideration. The cash back, the timing of the year, the equity that you've got might have increased, and we've got ways to assess all of the different variables. And our primary objective is option number one is always keep what you have. You can't go wrong there. If nothing changes, you keep what you've got. If another loan makes more sense, then we're going to take advantage of getting you into a better financial situation that meets your needs, not the needs of some general cookie cutter approach. Okay, so let's break a few options down for you and see how those look based on your specific scenario, and really see which one makes the most sense, what your needs are, and not just take a rate quote. Interest rates are a commodity. They change, they move. It's a moving target. There's way too many variables to just slap together a quick rate quote and payment. So let's dive into that. I'm going to give you several different opportunities here to look at different options. We're probably going to go a little bit deeper than if you picked up the phone and called an 800 number and talked to somebody that's sitting in a box or a cubicle. Because our primary objective is to put you in a better position, because at the end of the day we want you to tell all your friends and family that, hey, these guys really took the time to dig in and help us improve our financial goals.